Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. Hello and welcome to another special episode of Bondcast and Currency Exchange. And this week we are joined with a star-studded cast from the NatWest Strategy team. We've got Brian Daingerfield, Stuart and Joann Spadigam, and of course me as well, Imogen Bachra from the rate strategy side. So this week we will of course be going through the policy announcements from the new administration. There's been a lot of back and forth in the headlines, so we will just take stock of where we are now, what we're watching over the next couple of weeks and months, and of course what all of this has meant for currency and rates markets. We'll also preview what we're expecting from the ECB next week, and have a little bit of a think about what the announcements this week mean for the UK economy and how we're thinking about it in Europe as well. So without further ado, let's start with, of course, the topic that we've all been talking about this week. And I'll bring you in first, Brian, to perhaps just give us an overview, I guess, of where we're at in terms of the tariff policy discussion. We are recording this on Thursday afternoon, so things are moving relatively rapidly all the time. But at Thursday afternoon UK time, where are we now?
Yeah, sure. Thanks, Imogen, for having me once again. So I think where we are now is we saw significant escalation as part of the April 2nd announcements. The Liberation Day announcements were a lot higher than expected in a lot of cases in terms of tariff escalation. Since that point, we have seen the Trump administration pull back from those harsh levels in a lot of cases, but mostly on economies excluding China. They've actually upped the ante on China tariffs. So in terms of the specific numbers, the universal minimum of tariff of 10% stays in place, but all of the additional tariffs as part of the reciprocal tariff regime, so think the additional 10% on Europe, for example, that has been delayed 90 days to allow for negotiations. But China took the option of retaliating to the specific increases in tariffs that had originally been announced on April 2nd, which was 34%. So increasing the current tariff from 20% to 34%. As part of several different re-escalations, if you will, retaliations, the Trump administration has moved that total number all the way up from 54% to 125%. And so what we have seen is de-escalation in most major economies, but that's really been a pivot in terms of policy escalation, where we've seen meaningful pullback in some cases, or at least delay in some cases, but meaningful further escalation in others. And so what you see is, in terms of our own estimates, our economists' estimate of where the weighted average tariff level goes as a result of all of this, as recently as on Tuesday, when we had an escalation of the China tariffs without any delay in reciprocal tariffs, we were looking at a potential increase of the weighted average tariff to as high as 31% from 3% sort of as a rough average pre any tariff escalation before the Trump administration came into office. This targeted de-escalation does reduce that level in a meaningful way, but it doesn't reduce it all the way down to closer to where we were pre-escalation. So we're looking closer to the low to mid 20% in terms of weighted average tariff. So you're still looking at pretty meaningful tariff escalation as part of this. But what we have seen is the markets have finally gotten something that they were looking for a long time, which was Trump flexibility in the face of market moves. And we talked about this a lot last week, Imogen, this idea that what would it take for the Trump administration to become more sensitive to moves in markets? I think we finally hit that capitulation point because of not just moves in equity markets, but moves in bonds markets. So I'm sure that will be the focus of this discussion as we go through.
And before we go on to that bond market discussion then, two questions. First of all, from here, you talk about this still being a meaningful escalation from where we were just 2 weeks ago. What are you watching over the next couple of weeks and months? Because, of course, that 90-day pause was just a pause. It's not a commitment to not implementing those tariffs further down the line. So I suppose in terms of negotiation and retaliation, what might you be watching for? And then perhaps we can talk after that as well about the currency market impact and particularly the dollar, because there's obviously lots of discussion around the dollar smile and how the dollar is going to respond to this more positive news in terms of a bit of de-escalation.
Yeah, so in terms of what we're watching now, I think the biggest focus will, of course, be on US and China. But before we touch on that, we'll talk about the remainder of economies, where it feels like this might be a moment where trade related risks can maybe move back behind the scenes a little bit rather than being front and center of mind. I think that's something that market participants might welcome, but we should flag that there are maybe limits to this potential relief that can be caused by this because trade policy uncertainty is um, likely to continue. As you mentioned, this is just a pause, and there is still the risk that the Trump administration could respond to any retaliation or the lack of removing of retaliatory measures taken by or threatened by other economies as part of the reciprocal tariff regime. So these negotiations could potentially move maybe a little bit more into the background, allowing for maybe a bit of resetting of expectations in most cases. That being said, there's still potential sectoral tariff escalation that could still be coming and we know is already effectively in the pipeline. We just don't know how those announcements will gel with this delay that we've seen from the Trump administration on the reciprocal regime. So auto tariffs are still in place. The tariff on imported autos is still in place from sectoral tariffs. There is still an additional tariff that's planned on auto parts imports that for the beginning of May. That has not been changed as part of this reciprocal announcement. Additionally, pharmaceutical tariffs could still be in the works, and also specific sectoral tariffs on products like lumber, timber, and copper are all potentially in the works as well. And so we don't think we're necessarily through trade policy uncertainty in a broad level, but I think the hope in markets is that maybe this allows for these critical discussions to maybe move into the background a bit and allow for markets to maybe see at least a little bit of relief from some of the volatility caused by the very rapid changes in policy we've seen. As far as China is concerned, I think the markets are seeing what happened with the rest of the world and seeing there is now a glide path for the eventual steady state of U.S. China tariffs to move in a lower direction rather than higher. I think that's probably right over the more medium term, but I do think that there are challenges to how quickly we could see that be realized in actuality. And one of the challenges I think is from the first Trump trade war, one of the things that we noticed was that significant de-escalation in U.S.-China tension was often paired with an in-person summit between the two leaders, so President Trump of the U.S. and President Xi of China. One of the potential results of this targeted and larger escalation from the US and counter response from China is that this could delay the prospect of an in person meeting as a de escalation moment. There had been some reporting before the escalation on Liberation Day of a potential meeting as soon as April. That was from South China Morning Post. Other reports about a potential summit in June. That was from the Wall Street Journal. Uh, it's possible, I think, that the risk of a meeting coming later rather than sooner could mean that we're in for a period of further challenges here, and that maybe this de-escalation moment that markets think is very likely now, considering we've seen a de-escalation moment from Trump really for the first time in this Trump 2.0. I think the risk is that if this prospect for an in-person summit between Trump and Xi continues to be pushed off, maybe a point that the markets could be looking ahead to is the G20 summit in November. That was a period where during Trump 2.0, the two leaders met on the sidelines of the G20 summit in the past. That I think is what I will be looking for in terms of when we're thinking about serious de-escalation. I think a precursor to that could be an in-person summit. So that is something that I think we'll be watching closely. Now, you also mentioned the dollar and the really interesting dollar reaction that we have seen is that we have generally seen the dollar weaken throughout this period. And I think that's been, among other things, a reflection of the dollar still potentially losing its sort of exceptional gleam, if you will. Now, the Federal Reserve is in still a very difficult position, we think, in terms of inflation risk coming from its policy. The possibility that the Fed continues to stay in a wait-and-see mode, I think, is still very much on the table as a potential upside for the dollar if it feeds through their short-term interest rate expectations, maybe not meeting what the markets are currently pricing, the more aggressive stance the markets are pricing. But I think what you're continuing to see is the dollar faltering as a reflection of some expectations, shifting into alternative safe havens, for example, because trade policy uncertainty, I think, is still with us, and some of the growth risks are probably still there, even though they may not be as acute today as they were as recently as Tuesday when we had this significant escalation. So I think what we're seeing is still the dollar vulnerable relative to alternative safe havens. That includes currencies like the euro and the yen. And more recently, of course, you've seen rebound in some cyclical currencies to reflect the de-escalation stance. But very interesting to see the dollar response here, where it has not been all one way. We often get into periods of significant risk, either risk on or risk off, and changes in volatility. Normally, you tend to see the dollar either strengthening across the board, weakening across the board. You don't really have that nuance. Right now, it seems like markets are trading with a bit more nuance, and I think that reflects some of these risks that are still there, albeit maybe in different intensities for different regions.
Thank you, Brian. So that's probably a good point then to bring in Stuart, and we can think about the bond market implications of what has happened this week. Perhaps first and foremost, you can just talk a bit about the liquidity conditions that have become apparent this week and kind of what that tells us about the market at this juncture, Stuart.
Yeah, I mean, this is really a seminal event. The last 3 days are days that we're going to be talking about for the next 10 years. I think one of the first discernments to be made is that this is more evidence of a highly and overly constrained dealer community. Yesterday, swap spreads were probably 10 basis points tighter over the course of just a very few minutes. And what this comes down to ultimately is capital availability and the sorts of constraints that we were discussing several weeks ago that have negatively affected Treasury liquidity. One of the big problems is even in the presence of Fed liquidity is how to transmit that liquidity into the marketplace. And given the accounting regulations, it can be difficult because Fed liquidity does not currently net, say in FICC or other structures. So it's problematic from a balance sheet perspective in an already constrained environment to accept Fed liquidity and then transmit that back into the marketplace. Another thing that would address this that we've talked about is the GSIB surcharge, and specifically the penalty to short-term wholesale funding applied to repo financing for banks. That's something that I think that ultimately will be addressed. If anything, again, this is a stronger argument for the need for short-term relief on the capital front. Another of the issues, again, it's a constrained dealer community, and in times like this, we need the intermediation to maintain smooth market function. Along that same theme, yesterday there was some speculation about the durability and reliability of external demand, and I think this has been put forth both in terms of a short-term risk, i.e., a sort of buyer's strike, or a longer-term risk, whereby people will speculate that, for example, the structural current account surplus countries, might not buy treasuries, and how are we going to fund ourselves? Is there the possibility of an orphan long end, et cetera? And I think that's important to address, in particular, the longer-term structural issue. Will external buyers go away? The answer actually is interesting, I think, because it is probably. They probably will. But this will be a very slow, gradual process. And the important point here to make is that if buyers from outside the U.S. become less important, in all likelihood, it will be because of a change in U.S. national savings. If the U.S. is less of a current account deficit country, the U.S. will be building national savings that could self-fund, i.e., the U.S. will need less external capital. So in a world where there are persistent tariffs, or where there are tariffs that are very high and obviously intended to change behavior, we're not so worried about the integrity of the demand base. Again, because if the tariffs were to either be structural or to remain at such a high level that it changed behavior in the short run, it implies international investors being supplanted by domestic investors. That sort of demand uncertainty certainly did contribute to illiquidity at the long end of the market. There were auctions this week, reopenings of 3s, 10s, and 30s. Tens went reasonably well and have restored some confidence, but we still are confronted with curve steepening. We released a piece about this past week. We built a model of the term premium. The most important variable for term premium over the last several weeks has turned out to be inflation expectations, which we proxy with the Michigan long-term inflation survey. This is important because the Chairman Powell has sort of stated that he sees the Michigan survey as an outlier, which from a data perspective is arguably true. But the important thing statistically is this increase in inflation expectations fits the observed facts in terms of market behavior. So maybe it's an outlier, but the point is that either that variable or something it's highly correlated with is driving the curve steeper. And we do think it's inflation expectations, or perhaps even better said, inflation fighting credibility, which has been another theme of ours. Last point on this is I've had a number of questions on rationale for bear steepening, and I think it's instructive to see this issue through the prism of fiscal theory, which seeks to explain inflation and growth by changes in spending by fiscal authorities, and perhaps more importantly, the confidence of the investing public as to whether or not investments will be repaid in nominal or real terms. According to fiscal theory, two things can happen when the government issues debt. It can either be repaid by running surpluses over the longer haul, or it cannot be repaid, again here, in real terms. And the sort of interesting feature of fiscal theory is that we can show that in the absence of the intent to repay with future surpluses, the price level changes to make government revenue meet government liabilities. The point here would be that given the increase in debt to GDP in the U.S., so we're at about 125 now. Parenthetically, we started the financial crisis down in the 60s. The market is increasingly priced as if it thinks these deficits and this debt will not be repaid in real terms. And this isn't just about Fed credibility, this is about Fed volition. And so fiscal theory suggests that inflation is being consciously allowed to increase to decrease the real value of debt. And this is a problem because this is very important for international investors, to have the reassurance and backing of the Fed. And I think this is an issue that's going to have to be confronted. This is all about inflation fighting credibility. It's all about the dual shock to inflation and growth by the tariffs. And it's about the choice the Fed makes. Obviously, the Fed has to accommodate for growth impacts and inflation impacts. In terms of starting point, growth was above trend and in a better place than inflation, which is obviously above target. It's an enormously thorny issue, but our view remains that the Fed will have to come down on the side of inflation to tamp down these longer-term sources of theoretical concern, as well as short-term concern about potential buyer strike. So I will stop there, Imogen, and pass it back to you.
Thank you. Maybe that's the perfect time to think about the UK, because we've also been updating our projections this week and thinking about what the Bank of England might be doing in response to all of this. So it's probably worth saying that I think we spoke about it last week anyway, but we always felt like the UK, particularly compared to some of its peers, had kind of got off relatively lightly when it came to the announced tariff policy. This was sort of pre-de-escalation last week, but the UK was only subject to that 10% universal minimum tariff, which we felt would make the likelihood of retaliation on behalf of the UK quite unlikely. And we still think that is the case. And so with a small trade balance with the US and what was at the lower end of tariffs, we feel and still feel, despite the change in policy announcements overnight, that the direct impact from a sort of growth perspective on the UK is pretty limited. Where the UK will likely suffer more from recently announced policy changes is more on the indirect effects of tariffs. Mostly that, when we think about the UK economy, is likely to come through the business confidence channel. So a hit to capital expenditure. There's a risk that there is also a hit to consumer confidence, and we get some pullback in consumer spending as well. But I think particularly when we think about the UK economy, it's probably worth noting that there has been a big build-up in savings, probably precautionary, we think, by consumers. And that can potentially help to cushion some of that indirect impact via the consumer channel. Of course, the UK consumer is a bit different than when we think about the US consumer, in that the US consumer will have faced a very big negative wealth shock this week. You know, the average US consumer is exposed to the stock market in a bigger way than the average UK consumer is. So there isn't that same kind of wealth effect in the UK. That will be very concentrated at the upper end of the income distribution. But there will be a direct hit to consumer confidence, we think. But the primary influence to the UK growth backdrop from tariffs will be via the business confidence and what that implies for capital expenditure. So we have revised down our growth projections somewhat marginally. So this year we had growth at 0.9% year over year, and we've revised that down to 0.6%. And similarly, next year, we've taken about 0.4 of a percentage point off of our growth projections. So again, still not recessionary territory, but compared to sort of long run trend growth that we might consider to be around 1.25%, 1.5%, we are talking about even more sluggish growth in the UK economy than we were just a couple of weeks ago, which already wasn't an especially rosy outlook. On the inflation side, the picture is a little bit more murky, in the sense that you have this kind of downward revision to growth. You know, a weaker growth outlook should be disinflationary in the near term, but you have structurally, you know, longer term influences that are pushing up inflation. Rerouting of supply chains, shift towards deglobalization. You know, ultimately that is structurally inflationary, even if we have some cyclical disinflation in the near term from a weaker growth backdrop. So we haven't actually altered our inflation projections all that much, but we think the combination of a weaker growth picture and little altered inflation projections probably allows the BOE to be a little bit more easy in its monetary policy than we thought previously. So we'd previously been at the hawkish end of expectations. We had just two further rate cuts this year from the BOE, taking that terminal rate down to 4%. And we've just added one more rate cut in to take that down to 3 3/4, probably by November, we think. So they're still sticking to this kind of more careful, gradual pace of easing of once a quarter. But we think that perhaps the downside risks to growth just allow them to cut once more than we were expecting. There's still a limit to how much easier monetary policy can be, because that domestic inflation backdrop is still very sticky. You know, we're still in an environment where wages are high, unemployment is low, service price inflation is still running at a level that is, you know, not consistent with meeting the Bank of England's 2% target. So that limits how aggressive they can be on monetary policy easing. But we think this just opens the door to a marginally less restrictive monetary policy response. I think it's worth noting as well that we've heard from Breeden and Lombardelli, two of the kind of centrist MPC members, over the last sort of 24 hours. And although they've both recognised, you know, the sort of uncertain backdrop and the impact that this may or may not have on growth and inflation, they haven't been particularly concerned, I wouldn't have said, on what the US policy response might mean for the UK's monetary policy response. And they certainly haven't tried to toe a party line that this is going to need a particularly aggressive or forceful monetary policy response. You know, in some ways, what they have said has been quite similar to what we've heard from Chair Powell of the Fed, for example. You know, this is an uncertain macroeconomic environment. We sort of need to wait and see how this plays out before we can have any confidence in terms of the direction of travel of monetary policy. So that's our updated sort of macro projections. What does that mean for the market? Well, we've shaved our sort of near-term or front-end yield forecast a little bit, basically just to account for those lower growth projections, to account for that slightly easier monetary policy. But even so, we think that front-end yields have already settled at a level which are lower than we deem to be fair value. You know, we've seen a big rally at the front end over the last couple of days in the UK. And that seems to have extended beyond where we would put fair value given our bank rate call. You know, the market is pricing in still now a more dovish response than we are. The back end of the curve is a little bit different. I mean, it's clearly less influenced anyway by monetary policy decisions. But actually, you know, we haven't shaved anything off our back end yield forecast. And in fact, we revised them up a little bit, which, you know, recording this on Thursday, you might think is easy to say after the market moves that we had on Wednesday. But I promise the note was published before the 30 basis point sell-off that we had in long end gilt yields on Wednesday afternoon or through Wednesday. And really the rationale there was that, you know, our sort of bearish view at the long end has long been about our view of fiscal policy and how much that should and will, we think, weigh in the UK. We spoke last week with Brian about how we expect that actually the recent tariff announcement could also bring forward announcements in fiscal policy. We heard similar from von der Leyen in the EU in terms of the commitment to growth there and supporting it. And so I think, you know, once we can move past the volatility of recent headlines and the back and forth of the tariff headlines, the market will be very focused again on fiscal risks. And I think we've seen this week just how vulnerable the UK is to a rise in longer dated yields once fiscal policy kind of returns to market attention. The other point is something that we've discussed frequently on this podcast in the past, but a dynamic that I think we've seen play out pretty clearly this week is, you know, we've talked a lot about the structural shift in demand, how there's been a big shift away from overseas towards overseas investors rather from domestic investors. And a large part of that shift is pension funds buying far fewer gilts than they ever have before. Part of the reason that pension funds buy a lot less than they did previously is because we've seen an increasing trend for schemes to head towards buyout over the last couple of years. So what that is pension schemes essentially transferring their liabilities to insurers. And in doing so, the insurers take on their gilt portfolios. And what we would tend to see in that type of a transaction is the insurers then selling down their gilt holdings and buying something riskier, usually something like US credit, for example, to earn a bigger pickup. What we've seen over the last year, though, is that insurers haven't been selling those gilts. So they've just been sitting on their gilt holdings because gilts have looked relatively cheap, particularly if you look at them on asset swap, for example, and credit, US credit in particular, has looked quite tight. And so that trade just hasn't really made sense for them to do. But with a lot of the sort of tariff-related widening that we've seen in credit spreads over the last week or so, that trade has become much more sensible. And we've seen that be a catalyst for insurers who have been sitting on a lot of gilts to begin selling those in favor of something slightly riskier. So we still have relatively high yield forecasts at the back end of the curve. We still think that 10s at least can be in a range of kind of 475 to 5, and 30-year gilt yields can trade not far from really current levels, sort of 550. And so our sort of take on the moves this week are not similarly to the takeaways that we had back in mid-January, where we saw that violent gilt sell-off then, is that, the levels actually aren't that divorced from fundamentals. What is more divorced from fundamentals is the speed at which we are getting to those levels. And of course, in an environment like the current one, the market can trade quite far from fundamentals and certainly overshoot or undershoot in a meaningful way, given how volatile it is. But actually, where we are in the UK currently, we don't think that they are especially divorced from fundamentals. It's just the speed at which we've got to those levels feels a little bit overdone.
So the Bank of England also announced a small change to QT this week. How are you thinking about that?
Yeah, I think, certainly on Wednesday, there was lots of speculation or discussion around what possible intervention options the central bank might have to calm markets that were selling off rapidly. And, first and foremost, I think we always think of the Bank of England being able to cut rates, more aggressively or more quickly than we'd previously priced, and certainly that was the direction of travel for markets. That's why we kind of saw this significant steepening of the curve. Arguably, that was my sort of least likely option of things that they could do. And whilst I didn't think changes to QT were particularly likely either, I do think that in the current environment, that's a more sensible type of intervention in terms of responding to the issues at hand and making a difference. I think the market was perhaps hoping for bigger changes in the sense of thinking about something like pausing active QT, so pausing sales back to the market, whereas what the Bank of England have announced today is a very, very minor tweak. So they have announced that instead of doing a long bond auction next week, they will just do a shorts auction. So of the 3 QT auctions that they will hold this quarter, 2 of them will be shorts and 1 of them will be mediums. And next quarter, they will make up for that long auction that they haven't done by, I presume, doing an additional long auction, perhaps at the expense of a short auction. So in terms of adjustments to policy, it's very, very minor, particularly from a flows perspective. That long auction was going to be very small anyway. So from a flows perspective, this is not that meaningful. And from a fiscal headroom perspective, it's not that meaningful anyway. One of the reasons why the market gets nervous about quantitative tightening is because the Bank of England is selling bonds at a loss, and the more that yields rise and bond prices fall, and the Bank of England continues selling, the greater the loss that it's locking in. But unlike in other countries, the Treasury in the UK is on the hook for those losses. And so the more that the Bank of England sells back to the market, the bigger loss it makes, the more that the Treasury then has to sell to the market in order to cover those losses. So you run the risk of this kind of negative spiral, I suppose, when it comes to quantitative tightening. That is still a problem, but from a fiscal headroom perspective, any changes to QT now really don't make that much difference, because with the change in the debt definition, QT losses aren't included in that headroom calculation. So even if the flows channel were more meaningful, i.e. even if they plan to do more long auctions and they change their mind about doing those, from a fiscal headroom perspective, this doesn't really help. So it's very much a minor intervention, which helps from a signalling perspective. But in terms of the steps that they could have taken, I think it's at the very kind of lower end of intervention. But given that this wasn't a kind of homegrown issue when it came to volatile markets, I would have been surprised to see the Bank of England kind of be at the forefront of intervening in a much more heavy-handed way. There's lots to get through today, but I think it would be remiss of us to not also think about the impact of this week's announcements on the euro area, and how we're thinking about the market there too.
So, I think Europe obviously was first hit with that 20% additional tariff, which came in a bit higher than we were expecting. That's obviously been rolled back now. I think for Europe, the clear or the most favourable outcome really would be for these trade negotiations to work. Europe has said that they would like that to be the first case scenario, but obviously if that doesn't work, there could be escalation. What we got with the 20% tariff, I think, was probably the worst case scenario. So it does seem like to some extent that could be wound down and moved closer towards the 10% level. But I do think in terms of how we're seeing this in terms of growth in Europe, we've not really changed our forecast at this stage. So we essentially expect around 1% in growth for both 2025 and 2026. Even before, I suppose, we had this information about the tariffs, I would say we've been a bit more optimistic on the growth impact from tariffs. I think a 10% tariff, for example, would suggest that we get something like a 0.1 to 0.2% impact on GDP, and on 20%, it should be something like 0.25 to 0.3. So still a fairly small impact on growth from all of this. I think what the other side of the equation is that whilst we have this negative growth shock from the tariffs, there's also a positive story that I think the market has discounted to some extent in recent weeks, which really comes in the form of the fiscal package in Germany. Just a few weeks ago, there was a lot of positive sentiment around this package and positive implications for growth also from this package. So I think that is something that will also counterbalance the fact that there is a negative near-term growth impact from these tariffs. So I think net, there's uncertainty, firstly, both on what the tariffs will actually entail, and what the end point for tariffs is, and if there will be any European retaliation. Whilst at the same time, there's also this positive aspect from an improvement in growth that could come from the German spending package. And again, the details there are quite sparse at this point. So I think for now, we're leaving our expectations for growth unchanged for this year, and our ECB path as well.
Okay, let's just finish then thinking about the ECB, because of course they meet next week amidst all of this uncertainty. So what are you expecting, A, in terms of policy decisions, but B, are you expecting them to say anything in particular that might make you, rethink your policy path in the months ahead?
So the market is essentially pretty well priced for April, I think. Close to 25 basis points is being priced by the market for the meeting next week. So I don't think that cut will come with any surprise. I think what's quite clear is that both the hawks and the doves of the ECB at this point seem a bit more worried about the downside risk to growth. So we could get a bit of a dovish tilt in the communication, suggesting that if there is a negative impact on growth, that there could be a response from the monetary policy sense. Obviously, we don't expect them to be making any strong forward guidance or strong statements to drive the market. But if they do signal that the risks are moving towards further downside risk in growth, that could be clearly problematic and mean that perhaps we get further easing. I think on the inflation side of things as well, energy prices have moved quite drastically in the last few weeks, which again adds this downside impact on the ECB's March inflation forecasts. I think based on the renewed energy prices, the inflation numbers will be lower. The fixings for next year, for 2026, are lower than the ECB expects at the moment in terms of inflation. So with both growth which is to the downside, as well as the fact that inflation also looks like it might be lower than the ECB expects, the case for cuts continues to make sense. So we do have April and June cuts in for 25 basis points, as we've had for a while. I think what has changed this time around versus the last meeting is that in terms of where we see the risks being skewed, it is towards further easing than our base case. So the ECB potentially taking rates below neutral as a result of the negative impact on growth that we could see.
Okay, let's leave it there for this week. I think this week of all weeks, we probably could have talked all day, but let's not. Thank you all for joining me. Thank you to our listeners for listening in. We will be taking a short break next week for Easter, but we will return the week after and catch up on everything that we missed. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you soon.